The government claims printing money will stimulate the economy. But what if it only widens the gap between the rich and the poor? Discover the hidden truth of how printing money disproportionately benefits the wealthy while potentially devaluing the savings of everyday citizens. Could this well-intended solution actually fuel economic inequality and social division? So, what does it actually mean to print money? It's not always about literally printing more paper bills. Usually, it means the government, through its central bank, increases the amount of money circulating in the economy. This can be done in a few ways, like buying government bonds or lowering interest rates to encourage banks to lend more. But if it's that simple, why don't we just print more money to solve all our economic problems? Why can't we just print money to pay off all debts, fund schools and hospitals, and make everyone wealthy? The biggest reason is inflation. Think of it like this. If there are only 10 apples in a store and 10 people with $1 each apple will cost $1. But if you suddenly give everyone an extra dollar, there are still only 10 apples. But now people are willing to pay more. The price of apples goes up. That's inflation. When there's more money chasing the same amount of goods and services, prices tend to rise. Your dollar simply doesn't buy as much as it used to. This is known as reduced purchasing power. And who gets hurt the most by inflation? Often, it's people on fixed incomes, like retirees. Their pensions don't increase automatically with inflation, so they can afford less and less. Also, people who save money in bank accounts see the value of their savings eroded by inflation. On the other hand, people with assets like real estate or stocks might actually benefit because those assets tend to increase in value during inflationary periods. So, printing money can worsen economic inequality. In extreme cases, printing too much money can lead to hyperinflation. This is where prices skyrocket out of control. A good example is when a loaf of bread might cost $1 today and $10 tomorrow. The currency becomes practically worthless because people lose confidence in it. This is what we call currency depreciation. Central banks, like the Federal Reserve or the European Central Bank, are supposed to be independent from political pressure. Their job is to manage the money supply and keep inflation under control. They use various tools, like adjusting interest rates and reserve requirements, to achieve price stability and promote economic growth. It's important to remember that printing money isn't the only thing that affects the economy. Other things, like supply and demand, government spending, global events, and productivity, all play a role. For example, supply chain issues can drive up prices even if the money supply is stable. So while printing money might seem like a quick fix, it can have serious consequences if not done carefully. It raises important questions. How do we balance the need for economic stimulus with the risk of inflation? What's the right level of central bank independence? And how can we protect the most vulnerable members of society from the negative effects of inflation? If you found this video helpful, please like, share, and subscribe for more content like this. What other economic topics are you curious about? Let us know in the comments below.